Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Let's take a look at PayPal. Q2 earnings are out and they're pretty good. I own shares of PayPal, so FYI on that. I actually played some weekly options with PayPal as well. Those did pretty well because the stock was up almost 9% on the back of those earnings, up another 2% pre-market as of right now. The earnings solid, the CEO saying all the right things, doing all the right things, and the results are starting to show. And this is a company that kind of has been in the doldrums for quite some time. You go back 6 months, it's basically flat, sort of up and down. Whenever it falls into like the mid 50s, kind of in that range, that's where I really get interested. Long-term shareholders probably not too happy with the performance here, down 15% in the past year, down quite a bit in the last 5 years. This is a stock that was $300 during the pandemic as everything was up during the pandemic. Now is down into the 60s. And the valuation here, pretty interesting. We'll look at that in a second, see if it's worth buying after the earnings. But what's the story with the earnings? Well, everything seems to be doing pretty good. Branded checkout, Braintree, and Venmo contributing to transaction margin dollar growth. And it's the highest growth they've seen in that area since 2021. And that's always been the thing I look at really closely because transaction margin percent and transaction margin dollars have been down on the percentage side and the dollars have been flat for quite some time. Dollars started growing in Q1. Both are back to growth in Q2. So that's really good to see. And that's really what I've wanted from this company. And if that trend can continue, this could really be an interesting investment because that's really what you want to see from a company like PayPal. Again, PayPal isn't just that branded checkout that you see when you go to shop at random websites. The business that's growing the fastest is Braintree. It's their white label product. It's the company that does the payment processing that you don't really see. For example, when you check out an Uber transaction or you get paid as an Uber driver, Braintree is doing all that payment processing behind the scenes. Venmo, obviously a product that a lot of people use, a lot of people are comfortable with, peer-to-peer cash movement, etc. But they're doing some interesting things with Venmo as well. Hey, people have money in their Venmo accounts. Maybe we should allow them to do something with that money, whether it's Venmo debit or some other stuff. They're starting to build an ad product that obviously have 400 million plus users. That's not really anywhere yet, but that's something they're looking into. Can they make some additional money via advertising? That's only going to help their bottom line. And this is a company, the reason I got interested in this company is this is a company that generates a ton of free cash flow. Right now, they're using that to buy back shares, but in the future, could they do some acquisitions? Could they pay a dividend? Certainly possible. And because of all of these good results, because of the transaction margin dollar growth, because of some cost savings via layoffs and other cost saving initiatives, they're investing that into growth initiatives. They're releasing new products, signing new deals, expanding partnerships with Meta and DoorDash as they covered on the call, and most of all, raising guidance for transaction margin dollars, EPS, free cash flow, and share repurchases for the full year of 2024, and free cash flow going up by $1 billion over previous guidance. So that's not too bad. So look at the earnings. The earnings themselves pretty solid here. 11% growth on total payment volume, 8% growth on revenue, 8% growth on transaction margin dollars, 36% growth on non-GAAP EPS. Quite a beat against what they projected, both on the revenue side and the EPS side. That's why the stock was where it was. If you look at where the growth is coming from, again, it's unbranded, it's Braintree, it's Venmo on a smaller scale. Branded is still growing. So this is kind of the thesis around why PayPal is doing poorly. Well, this is a dying company. Well, the results aren't showing that. There is a lot of competition here. You've got competitors in the payment processing space, Klarna, Stripe, etc. You've got competitors in like the peer payment space, Apple Pay, all of those phone apps. You've got competitors like Cash in the peer-to-peer space. So a lot of competitors out there, and that's certainly why this stock is struggling. The market just doesn't think they're going to be able to grow a lot and potentially going to start shrinking in the near term, and then also probably are going to see pressure on their margins. But they're kind of reversing that trend with these earnings. They talked about how Braintree, they're focusing more on value now versus just growth at all costs. Obviously, growth is slowing in Braintree, but that's on purpose because they're charging a bit more money, actually trying to make that business more profitable. They're trying to make Venmo more profitable with additional services. They're looking at other services, other merchant services, whatever those are. I don't actually know exactly what that includes, but I think Hyperwallet is the majority of that, growing at 15%, still a small part of the business. But they've got a lot of growth areas that they're now focusing on. They're trying to make branded checkout better, Braintree have more value, and actually give more profit to the bottom line, Venmo, have more value to the consumer, and actually make some money off of that product. A lot of good things that the new CEO is doing, and I'm happy to see all that actually show up in the bottom line. And it is already guidance for 2024 better across the board. Before they were expecting slightly positive transaction margin, now low to mid single digit growth, way better than anything they've seen in the last couple of years. You look at GAAP GPS improving by about 20 cents, free cash flow improving by $1 billion, and because of that, share repurchases improving by about $1 billion. So they're going to buy back $6 billion worth of shares in 2024. This is a $65-ish billion market cap company. After the bump yesterday, you're talking about 10% buybacks within the year. However, they do have about $1 billion and a half stock-based compensation, so it's not all going to reduce the share count, but you're talking about 7 to 8% share count reduction as long as the stock price stays where it is. That's pretty good. So what's important here? What matters? Transaction margin, and this is what stands out to me. Another thing that stands out that I'll mention: active accounts growing again. So the trend was in the last couple of quarters, active accounts shrinking a little bit, but now growing by 2 million between Q1 and Q2, growing monthly active accounts growing by 2 million between Q1 and Q2, still lower than they were at its highs here, but they talked about how they're kind of shedding unprofitable accounts, and to see that grow again is a really good thing after that's already happened. They do expect total payment volume growth to drop off a little bit, again, concentrating on Braintree growth that's more profitable than just growth at all costs. And that's a good thing because you're starting to see it in the results. Transaction margin up 8%. Again, this is something that's been kind of down in the last couple of quarters. This is the highest growth since 2021. Transaction margin percentage, still a lot lower than it's been in the past because of Braintree's volume growth, 47.1% in Q1 2023, now down to 45.8%. That's kind of expected because of how fast Braintree is growing. But now that they're reversing that, is this the start of a trend, or is this just a one-off, up 80 basis points over Q1 2024? Almost flat against Q2 2023, so that's good to see. And really important part is transaction margin dollars up 8%. It'll be interesting to see what happens in Q3, Q4, because if they can keep that trend going, if dollars keep going up and up and up and margins start reversing, this could be a really interesting investment, because the valuation here is still very conservative given what's happening with the business. Again, this is a business that's generating $6 billion in cash flow that is being valued at a $65 billion market cap. This is a business that's got a fantastic balance sheet, $18 billion in cash and cash equivalents and long-term investments versus about $12 billion in debt and capital leases. So you've got a pretty solid balance sheet that, again, they could use to make additional buybacks, eventually issue a dividend, make some strategic acquisition, a lot of flexibility. So again, the market kind of hates this stock because of all the competition out there. But if they can maintain some semblance of growth, if they can slightly improve margins, this could be a very interesting investment in the years to come because of where it's valued, because of the sentiment around the stock. So as I look at the valuation here, disclaimer, video is informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. So as we look at this based on the latest value of the stock, this is a company that's valued at 66 billion, an enterprise value of about 63 billion, just north of a million shares. This is a company that had almost 1.1 billion shares, 1.1 billion shares as of last year. Now getting close to a billion shares, going to be below that soon. So a lot of stock buybacks, driving the share count down, which is only good for current shareholders. Again, if you're somebody that bought at 300, you're probably not very happy with the performance here. But if you're somebody like me that was buying in the mid 50s, maybe even high 50s, you're probably pretty happy with what's going on with the job that the new CEO, Alex Chriss, is doing. So as I look at the growth potential here, I'm kind of assuming, kind of 8% growth for this year. Margins kind of telegraphed where they are at the $6 billion in free cash flow. Those margins staying relatively flat, maybe improving a little bit in the next couple of years. I know there's going to be competition. I think they can certainly improve margins on Braintree, but there's probably going to be some pressure in other areas because of that competition. Growth is going to slow. I'm expecting 4% growth. So being a bit more conservative than the estimates here are showing, ending up about $5 billion lower than the estimates, and a good deal lower on the free cash flow side because my margin assumptions are a bit more conservative as well. The assumption here is that the majority of their cash is going to go towards buybacks in the next 5 years. They're shown that in the last year. $6 billion in buybacks, offset by stock-based compensation, leads to about $17 billion in buybacks in the next couple of years. I think that's reasonable. I do think it's also reasonable that somewhere within this period, once kind of they're back on the growth pattern, they institute a dividend, get into some of those dividend ETFs. I think that'll help valuation. That's not coming anytime soon, but I wouldn't be surprised if it happens in the next couple of years as long as the business remains steady. As I look at the valuation here, even after the bump yesterday, you're getting a 9% free cash flow yield on the next 12 months of free cash flow. If you think about a 9% free cash flow yield on a business that's growing at 8%, 8 to 7% in the next year or two, it's pretty solid in relation to what you get from the market. There's a lot of stocks growing at 1 to 2%, getting a 5% free cash flow yield. They're in potentially less competitive areas, potentially a better brand name, potentially just a better stock performer. This is a stock that's kind of been beaten up and kind of left for dead. And I understand why people wouldn't want to buy this stock because of the trend just isn't good. And sometimes trend does matter. Sometimes momentum does matter. And the momentum here is really bad. But if you're comfortable, as I am, just sitting here on the stock and waiting for potentially that momentum to shift, this thing could explode really quickly. As I look at the valuation here, I have an 8% free cash flow yield scenario modeled out based on these assumptions. That kind of gets me to an expected return of about 11.7% from today. I kind of think that's market beating, and I think there's some upside here. If you look at this thing returning some to transaction margin growth and the market reevaluating how it looks at it, even some margin expansion, moving to a 7% free cash flow yield, a 6% free cash flow yield, could generate high teens, low 20% returns if things go the right way. And I think the downside here is maybe more limited than some of the other stocks that are growing really fast, that have high multiples, because I don't think this is a business that's going to go underwater anytime soon. I think PayPal is still a decent brand name. They have a ton of active accounts. It's not just in the United States, it's worldwide. I think Venmo is a solid product. They can monetize that. I think Braintree is a solid product, one of the best in breeds in the white label space. I think they can show value there and start improving margins on that front. So even if the PayPal branded products start shrinking a little bit in the next 5 to 10 years, I think some of the other stuff can make it up. And I don't need the stock to suddenly grow at 10% for this to be a decent return. As long as it grows at even a smaller clip than this, like you could probably consider this growing in the low single digits by the end of this period. And as long as margins are kept up, this could still be a very interesting return, because what they're going to do is they're going to buy back a ton of shares, return that money to shareholders, reduce the share count, and each individual share is going to be worth that much more as the free cash flow continues to be there, because this is a company that's been consistent even during 2020. Obviously, they benefited from that, but they did pretty well. So solid free cash flow generator, solid margins here. It's a pretty good business. I'm not putting all of my money into this basket because I know that the competition is very, very strong in this space. And I'm worried that that is going to change the thesis a little bit. But when I look at the stock, when I look at this valuation metric I have in here, I get a fair value around $69. And I already own a bunch of these shares, but $69 versus a price of 64 makes me interested in it again, especially now that the trend is moving in the right direction. When I was buying it at 55, it was with the hope that the trend would move in the right direction. And now the trend is actually moving in the right direction. If I want to be a bit more conservative, aim for a 15% return, gets me back to that $55 price point, which has always been my target. And it's not that I'm always buying at 55. It's like it's in that range. It hasn't really hit 55 for a while, but like sometimes when it hits 57, I'll buy a few shares here and there. And that's kind of been my strategy with PayPal. But I'm also very much okay with just sitting on this and expect it to just kind of be flat money for quite some time, because the market just doesn't believe in this story quite yet, and the momentum hasn't shifted in the other direction. But I think once it does, this could be a very interesting investment. And right now I'll sit on my shares, but if it does the standard PayPal thing where suddenly the earnings are good, it jumps up, but it starts trending down into the high 50s again, I may increase my position because of those results. So let me know what you think. Do you think PayPal's earnings are good? Are you liking what the CEO is doing? Leave a comment down below. Leave a like, subscribe if you're new, all of that good stuff. Thanks for watching, and bye.